A building worth $68 million sold for $4 million. Another, valued at $302 million, went for $45. We're not talking about abandoned properties in forgotten cities. We're talking about towers in the heart of one of the largest economies on the planet. Something is happening to the American commercial real estate market. A silent collapse that started on office floors, moved through city halls, and made its way into public schools. And while some buildings are selling for a fraction of what they once were, other sectors have waiting lists before they're even built. If you think this is a problem for investment funds and big banks, wait until you understand where this bill actually ends up. How did a market that seemed immune to crisis get to this point? Which sectors are sinking, and which ones are exploding in the middle of the chaos? And what does this collapse mean for cities, for workers, and for the American urban model? Before we answer that, we need to go back in time. To understand what's happening right now, we need to go back a few years.
Well, now there's a new study finding that more than 75% of homes across the U.S. are unaffordable.
The numbers speak for themselves, and they are brutal. In Chicago, the building at 401 S State Street in the historic Printing House Row District recently sold for $4.2 million. In 2016, that same property was worth $68.1 million, a 94% drop in less than a decade. In the same city, 301 S Wacker Drive, that tower that sold for $302 million in 2014, changed hands for $45 million, an 85% discount. The building at 300 W Adams Street, worth $51 million in 2012, sold for $4 million, a 92% decline. Boeing's leasehold interest in 100 near Riverside Plaza dropped from $165 million in 2005 to just $22 million today, an 87% loss in value. And it's worth emphasizing, this isn't the building itself. It's just the leasehold interest, the right to occupy the space. Even that lost 87% of its value. Outside of Chicago, the pattern repeats. In Dallas, an 18-story office tower went from $73 million to $26.1 million, a 64% decline. In St. Louis, a 44-story skyscraper that fetched nearly $205 million in 2006 sold for $4.5 million in 2022. A fraction of 2% of its original value. In San Jose, California, a corporate office building dropped from $80.1 million to $23.7 million. In Newton, Massachusetts, a three-building complex fell from $235 million to $117.5 million in just 5 years. The national office vacancy rate hit 19.4% in July 2025. In Austin, it stands at 27.2%. In San Francisco, 26.3%, meaning nearly 1 in 4 square feet of office space is completely empty in the two cities most associated with the American tech economy. Delinquency rates on commercial mortgage-backed securities reached 7.29%, nearly 6 times higher than traditional bank loans. And 278 U.S. banks would be considered vulnerable under a scenario of 8% losses on their commercial real estate portfolios. The debt picture is equally alarming. With $957 billion in commercial loans maturing in 2025 alone, and another $539 billion due in 2026, the sector faces a refinancing wall unlike anything in recent history. Much of that debt was taken on when properties were worth far more and rates were far lower. Now the bill is due. But there are signs that the market may be bottoming out. New office construction is at its lowest level in more than 3 decades. And as the supply of quality space grows even scarcer, companies that need the right workspace are being pushed to act. For large office users looking to secure high-quality space, the message is clear. If you find the right space, act decisively. There is strong demand for new, high-quality space and not enough of it to go around. Given the limited construction pipeline, it's going to get even tighter. If the office sector represents the dark side of this story, the industrial market is its most intriguing counterpoint, and perhaps the most underrated. Since 2022, industrial construction has fallen 63% in the United States, a steep drop that might suggest total collapse. But that is, in fact, setting the stage for a rebound. Net absorption of industrial space is expected to jump to 220 million square feet in 2026, driven by the return of some manufacturing to American soil, the growth of e-commerce, and above all, the explosion of data centers. Think of it like a rubber band stretched too far in one direction. Construction stopped. Demand came back. When the two meet, prices will rise. The drivers of this growth are structural, artificial intelligence, industrial reshoring, and the growing need for physical infrastructure to support the digital economy. Warehouses that once stored goods are being converted to house servers. Others are being built to accommodate production lines coming back from Asia. And the waiting list for this type of space is growing fast. While the world was debating the death of physical retail, the sector was doing something else entirely, shrinking strategically to survive. In the first 3 quarters of 2025, nearly 26 million square feet of retail space was leased in non-traditional properties. inside residential buildings, universities, hotels, and office towers. Retail moved out of big malls and went to where the people already are, integrating itself into daily life rather than trying to create a separate destination. The average size of retail leases signed over the past year fell below 3,500 square feet for the first time since CoStar began tracking the data in 2016. Chains like Starbucks, Chipotle, Chick-fil-A, Jersey Mike's, Dunkin', and McDonald's are leading this transformation, betting on smaller, more embedded formats. It's a quiet but profound shift. The retail model that defined the 20th century, big stores, big parking lots, big malls on the outskirts of town, is being replaced by something more compact, more accessible, and more woven into the places where people already live and work. But there's a warning that can't be ignored. Significant uncertainty remains around the impact of tariffs on an already fragile consumer. While suppliers and retailers have largely absorbed these costs to date, many have signaled that price increases are imminent. With consumers already showing some signs of spending fatigue, tariff-related price hikes could further strain household budgets and dampen discretionary spending. The rental apartment sector spent years at the top, leading institutional sales volume in American commercial real estate since 2015. It was the preferred asset of major funds, the safe harbor in a turbulent market. But the picture is changing. A record volume of new units hit the market in 2025, pushing rents down. The logic is simple. When supply exceeds demand, prices fall. And it's happening across multiple markets simultaneously. Investor sentiment in this segment has weakened for 4 consecutive quarters, a sign that confidence is eroding consistently, not just temporarily. The sector led investment sales volume since 2015. It was the safe harbor for an entire generation of real estate funds. Seeing that leadership now being challenged is, in itself, a meaningful signal of market reconfiguration. Its share of total investment volume is expected to ease in 2026 as capital shifts toward quality offices, data centers, and compact retail. Across the board, 49% of investors plan to simply hold their current commercial real estate exposure over the next 6 months, neither increasing nor reducing, a sign of broad caution across the entire sector. In the middle of all this, one segment of the commercial real estate market is living a completely different moment, one that seems almost unbelievable compared to the rest of the sector. Deloitte called it a clear bright spot in the U.S. commercial real estate landscape. Data centers, the massive complexes that house the servers powering the internet, cloud computing, and now artificial intelligence, have waiting lists. In 9 major global markets, 100% of the new construction pipeline is already fully pre-leased. The buildings are being rented out before they even exist. The engine is artificial intelligence. The explosion in demand for data processing and cloud infrastructure is creating an unprecedented scarcity of physical space for servers, and that space has to exist somewhere, with power, cooling, and security. That place is the data center. The contrast with the rest of the market is striking. On one side, office towers that were worth $300 million selling for $45 million. On the other, server warehouses with waiting lists before they're even built. The same real estate market. Completely different worlds. But even the hottest sector isn't immune to headwinds. Data centers face bottlenecks in financing, grid capacity, zoning, and local political resistance. Some projects have already been abandoned. And Colliers forecasts that more will be shelved in 2026 as communities push back against the impact of these complexes on local infrastructure and the environment. Beyond the office collapse and the rise of data centers, there's data pointing to a broader market reawakening. And it deserves attention. Transaction volume in the third quarter of 2025 was up more than 40% year over year. Lending grew 35% annually. Institutional sales rose 17% through October. Colliers projects a 15% to 20% increase in total sales volume for 2026. Falling interest rates are unlocking capital that had been frozen for years, and leasing fundamentals are stabilizing or improving across most segments. In the capital markets, the spread between government and corporate bond yields has narrowed to around 1 percentage point, well below the historical average. CoStar notes that this kind of compression has historically been a precursor to increased real estate investment and firming prices. Banks are lending again with more appetite. Institutional capital is returning, still cautiously but consistently. The optimism is real, but it comes with a caveat that says a lot. 83% of industry executives expect revenue to improve by the end of 2026. A year ago, that number was 88%. The market is recovering, but nobody is celebrating yet. What all of this means for cities, workers, and the American urban model as a whole, that's what we'll look at now. The numbers we've seen throughout this video aren't just market data. They tell a story about how work has changed and about the price cities are paying for that change. A tower selling for 4% of its value from 10 years ago isn't just bad news for an investment fund. It's a symptom of something structural, a permanent reconfiguration of where and how people work. Remote work was not a passing phase, it was a behavioral shift, and the commercial real estate market is footing the bill. But that bill isn't limited to investors. When commercial property values collapse, cities lose tax revenue. Less funding for schools, less for law enforcement, less for public transit. The commercial real estate crisis is ultimately an urban crisis, one that starts on the empty floors of financial districts and ends in the budgets of the city governments that depend on those properties to fund basic services. The financial impact is broad and concrete. With 278 U.S. banks in a vulnerable position and nearly $1.5 trillion in commercial loans maturing between 2025 and 2026, the pressure on the financial system is real, and it isn't over yet. But the market isn't simply collapsing, it's reorganizing. The survivors are those who adapted. Class A offices, well located and built for hybrid work, are nearly fully occupied. Construction at its lowest level in more than 3 decades will make quality space even scarcer. And those who hold the right property in the right location may emerge from this crisis in a stronger position than they entered it. The sectors that are thriving are those tied to the new economy. Data centers powering artificial intelligence, industrial warehouses for reshoring, compact retail spaces embedded in everyday urban life. Capital is coming back, but selectively, cautiously, guided by data and strategic conviction. The deal environment rewards those who can combine data-driven insight with strategic conviction. For clients, the challenge and the opportunity is to navigate a landscape where liquidity, technology, and consolidation are redefining the meaning of value creation in real assets. Source 1. There's an image that captures this moment well. On one side, a 44-story skyscraper in downtown St. Louis selling for $4.5 million, less than a luxury apartment in Manhattan. On the other, server warehouses being leased out before they're built across 9 markets around the world. Same real estate sector, the same economy, completely different worlds. And so the question remains, one that perhaps no one can answer with certainty: will American downtowns reinvent themselves, or will empty buildings become the permanent symbol of an era that's over? The commercial real estate market is in free fall in some places, recovering in others, and transforming in nearly all of them. What is clear is that the world these buildings were designed for no longer exists.